Hi, everybody. So this is going to be a quick coding demo on the 2025 spring midterm exam for financial data analysis and practice. A couple notes as I get into it. I am not going to be giving 100% quality answers. So as noted in the instructions, full credit is going to involve discussion of context and implications of the analysis. And I'm going to just do some of that as voiceover, but not actually try to get all that stuff done. Okay, so I've got package imports here. I'm going to import stuff as I need it, but not add anything along the way. Write a Python function called integrity that takes two arguments. So let's define a function called integrity. It's going to take a string called name and a Boolean called honest. If honest is true, your function should print, let's just copy it out of the instructions here. Name will neither give nor receive unauthorized help on this exercise, and otherwise we're going to print name do not agree as indicated. Okay. And so hopefully that guy is going to get the job done. We can check the test cell, which says not to modify it, and everything looks as expected. And then part 2 says use your function in your own full name to confirm that you are not going to cheat. Okay, gotcha. Looks good. On to the next question. So from the course Canvas page, you're going to download a PDF file that combines one-page handouts, and that is a 47-page PDF. Each page is a group project. So question A asks us to write code that prints a list containing 3 randomly generated integers, each between 1 and 47. So I'm going to import random up here in my imports. And now what I want to do is I want to generate 3 randomly generated integers, each between 1 and 47. Let's see, start equals 1, stop equals 47. I want to get 3 of them. I should check whether they're equal to each other. Count equals 3. So either I could generate these one by one and check whether they are identical, or I could generate 3 at a time and check whether they are unique. If not, I could generate a new list. I could do that using like the length of a set. Or I believe there is a function called random sample. Let me check. Chooses k unique random elements from a population sequence. So let's do that. Using a range, which starts at the start, ends with the stop plus 1, so that it's inclusive of 47. And then I think I want to get k equals to the count. So let's see what that does. That does seem to generate a list. And the code assignment asked me to print that guy out. So I'm going to check on projects 11, 12, and 27 using the page numbers. I wonder if, nope. Let's see. Is there like a sorted? No. Well, there's got to be a way to sort them. And I can't remember what it is, so I'm just not going to bother because this did not ask me to do it. GPT or other AI help would be useful there. Okay, so part B is going to ask me to go read about those 3. So noting that my code may get updated, or if I rerun it, I may get another list. I will summarize projects 9, 16, 36. May change if there's a code update. Okay, and we get 9, 16, 36. Summarize here. Okay, so I'm not actually going to go get the PDF and read those things, but there would be a good way. And then in part C, I'm going to pick 2 of those projects, and I'm going to describe a financial question that would integrate and could be answered using 2 of those 3 techniques. Okay, so now I'm going to go on to question 4. Suppose you hold a call option that matures right now, has a strike price of K, and the underlying asset is currently trading at price P. Write a function exercise that takes 2 arguments K and P and returns a Boolean. So let's def exercise, and it's going to take arguments K and P as requested. It's going to return a Boolean indicating whether or not you should exercise the option. So I'm going to return, when do I want to exercise? Well, it's a call option. So I want to exercise if P is greater than or equal to K. The indifference condition where P is equal to K, I could resolve either of 2 ways, and I can check and make sure that these do what I expect them to do. And indeed, they do. There's lots of other ways to have implemented exercise. But that is a great one. I could add a note that says, note if I wanted to not exercise at equality, could do that. Okay, so that might be a good way to do it, but I think I feel good about this guy. Okay, let's get the payoff function. The payoff function should take the same 2 arguments. So that was K and P, but let's just check. Yep, K and P, capital K, lowercase p. And I'm going to, if the option is out of the money, the payoff should be 0. I'm going to return the payoff. So a couple ways to do this. I could do this using a max. And so I could just return the max of P minus K and 0. Okay, that's a good way to do it. Or alternately, I could instead do something like simple implementation, or I could say if I'm going to exercise, and the idea with this mainly would just be that if I wanted to maintain flexibility to consider some other type of option elsewhere, I could change my exercise rule, and then that could flow through to my payoff. So I could do something like this, else return 0. Okay, and I think that's going to give me the same answers, except I check and I say, oh man, no, it looks like I got a minus 20 as my payoff. And so I'm going to go back and debug that to be P minus K. And that looks good. What I don't want to do is I don't want to check if K greater than or equal to P, because I've already implemented that check, or sorry, if P greater than or equal to K in defining my exercise function. So I don't want to repeat myself. And I should just use exercise rather than re-implement. Okay, simulation part 1. Suppose the exercise is P and it's, that P is normally distributed with mean, mu, and standard deviation P. So let's, sigma. So let's say P equals random dot normal variate, and it's going to take a mu and a sigma. Okay, this, of course, right now, if I run it, will give me an error because sigma and mu are not defined. We're going to write a function sim that takes the following arguments. Okay, so it's going to take the arguments K, the strike price, mu, and sigma, and it's going to generate a P using random normal variate, and then return the optimal payoff. Return the payoff at K, comma P. And so I can just make sure that indeed I've given those the right names. If I weren't sure, I could always just make sure that this stuff works as expected. And I'm going to run this code and make sure that it works as expected. So if K is 100 and mu is 95, that means the call option is out of the money. So it should exercise less than half the time. And indeed, I get 2 out of 6 exercises, it looks like. The second one, K is 25, mu is 24. So this one, I feel like should exercise, it's also out of the money. It should exercise less than half the time, but it exercised 0 out of 6. Did I screw up? Let me try to run it again. Yeah, it looks like it was just getting some bad realizations in terms of exercise. So Could run this guy a few times and just see that things look more or less as I expected. And indeed they do. I'm going to leave mu and sigma and k without default variable values, just because if I don't put them in, I do want to error out. Okay, let's go to simulation part D. We're going to run the simulation function 1 million times with k equals 5. Sorry, we're going to run the simulation 1 million times with k equals 75, mu equals 70, and sigma equals 12. So let's run for a range equal to 1. You know what? Let's call this n. We'll set n equal to 1 million. And how many times for this equals range n? Let's run sim with k and mu. So actually, why don't we make a list of all the results? We could do that by initializing a blank list and appending them, but let's make a list of our sims, and sim is going to take, here's my sim, it's going to take k, mu, and sigma, so we'll copy that guy down. Okay, so we've got sim for k, mu, and sigma. We're going to run that n times. And let's actually, why don't we functionize this thing? So def sims, and we're going to take k, mu, sigma, and n. Okay, so actually let's make 1,000,000 our default argument for n. And that way when we run this thing, we should get 1,000,000 sims of n. And so we could just return the simulations themselves. So let's return those guys and make sure, oops, what did I do? That I don't want like that. So let's make sure that if we run k equals 75, mu equals 70, sigma equals 12, that I could run this guy, and hopefully what I'm going to get is a list of length 1,000,000. That should have taken a little while to run. Okay, that looks good. So that's giving us a list. And what do we want to do? We want to check the average payoffs. So let's define average payoffs. And let's take that from a list of sims. Okay, and we could do this more efficiently using something like NumPy, but let's not bother, and let's return the sum of sim results divided by the len of sim results. Okay, and so can just check that this thing seems to work as expected. Okay, so we're getting an average payoff of 2.7. If we run it again, we should get a slightly different number, but a similar one. Whoops. Okay, the next question is going to ask what fraction of time this thing winds up in the money. So this is in the money fraction, and we're going to take not the sum divided by the length, but let's take the sum of a list, which is equal to 1 if sim is greater than 0 for sim in sim results. So we're going to check each of the sim and sim results. If it's 0, we're going to put a 1 in the list. And we're going to take sum of 1 if this expected what did I do wrong? so something dumb. Sim results, that should be a long, oops. Okay, and so now I should be able to get, no, this was the code I was having trouble with. Was this list? Oh, dumb. The 4 has to come, the if has to come after. That's what it is. So 1 for sim in sim results, if sim is greater than 0. Let's try that guy. And I think then, let's make sure this works. So we'll run our sims, will generate it. And then we only want to generate them once. We don't want to generate the same simulation more than once so that the calculation of average payoffs and in the money fractions. Okay, and so it looks like that's working. Let me try to run it again. I'll run another million. Looks similar. Okay, so that is going to be sufficient to get an answer for 1 in terms of coding. What's the average payoff of the option? We've got a $2.70 payoff. And then what fraction of the time does the option expire in the money? 33.8%. And we expect this to be less than 50% of the time because this is an out-of-the-money call option. And so an out-of-the-money option should expire in the money less than 50% of the time, given the model that we have. And we would also just note that it's realistic that since K is $5 greater than mu, we're talking about being in the money if the realization is more than plus 5. Sigma is 12. And so we're talking about less than half a standard deviation above the mean. It makes sense that we get something of roughly this magnitude. Okay, so that's what we get, and some financial interpretation. Now, question 3 asks us, what would you expect to get if we instead increased mu by $1 to 71, a bigger, smaller value, by how much, and then let's assess it. So if mu were bigger by the dollar, then there's going to be 2 effects. One is going to be that the likelihood of being in the money is going to be slightly higher because now instead of needing to be a realization greater than $5 from above the mean, we only need a realization $4 above the mean. So we're going to have a slightly higher probability of expiring in the money. But the key thing is that conditional on expiring in the money, the whole distribution is shifted up by $1. So conditional on expiring in the money, we are going to have a realization which is $1 higher. That's currently happening about 33.8% of the time. And so we should expect that the value of the option should increase by a little bit more than $33.8 cents. When we expire in the money, we're going to get an extra $1. That happens 33.8% of the time. That's going to increase the value of the option by 33.8 cents. And then there's also going to be a little bit of extra value coming from the fact that the expiration should happen slightly more often than it did before. So why don't we take this guy here and we can say def, let's see, summarize sims, and we'll take, let's say, we're going to take K, a mu, a sigma, and an N, which we can leave at our default, like this. And we will then return these guys like that. And so now this down here, we can run our old code like that, and get an answer that should be numerically very similar to what we got before. And then we could say low, let's see, we could say V1 in the money frac. No. You know what? No, let's try, let's do this guy, and let's try to do, let's make a list of what we get for mu in, and we'll do 70 and 71 per the question. We can leave K and sigma where they were before. Okay, and so we should get two sets of results. Results to compare is going to equal those results. We can print the results to compare. We could obviously pretty them up. And then we're going to get results to compare. Let's get the first element minus the 0th element. Okay, and so we're going to see by how much the delta actually, sorry. Oh, I want the first element, which is the first simulation, and I want the, oops. Okay. So we get that, in fact, the value of the option went up by 36 cents, about 34 cents of which was coming from higher payoff when we're in the money, and then the residual is coming from the fact that we are in the money slightly more often than we were before. Okay, so this is actually two different ways of measuring delta. This is looking at delta, which represents the in the money fraction, or delta, which represents the change in the value of the option as the value of the underlying increases by a little bit. Okay, part 3. In the last question, we considered the effect of the option price increasing value by underlying from 1. Do we get the same effect of changing mu at values of sigma other than 12? Explain what you think is going on in financial terms. So let's try to start by, we're going to leave, let's leave K the same as it was. You know what? Let's take our old code here, and we're going to def, and so what is this? This is the delta as a function of K, sigma, let's get all the arguments, K, mu, sigma, and N. Okay, so we've got those guys. And what we want to do is we want to generate two. The only thing that's going to change is we're going to run this guy at K mu sigma N for a K and a sigma as provided, and a mu, which the mu will start at some base mu, and then we'll increase it by 2 mu plus 1. So we'll try the provided mu, and we'll try mu plus 1. And what we'll do is we can return the difference in values. So is this going to work? Let us see. maybe, maybe not. So we're going to check for a 75 and a 12. Let's see what we get as the increase when, okay, so we get a delta. Before we got a delta of 36.17 using that discrete change. And it looks like we've got it as expected. So maybe what we should do, or we could go back and we could say, what's the word for this? We could recode this using function created below. The word I'm looking for is refactor. We could refactor this if we have time to avoid repeating ourselves now that we've turned it into a nice function. But let's not bother. And so what we could do now is we could start with a K of, let's say, 75. I guess we just used a mu of 70 was what we did here, right? Was that our favorite mu? And we got that answer from before. And so now what we could do is we could make a list of these for sigma in, and let's try some different sigmas. So how about, let's make a range. Let's start with, I don't know, 6, and we'll go to 24, and we'll go by 2s. So that'll give us 6, 8, 10, 12, 14, 16, 18, 20, 22. Each of those is, so we're running 9 of them, I guess. Each of them took a little while, a second or so to run. And so now what we can see is it looks like for, that one's not actually getting used, for K of, I guess could make this clear that this was mu. And it looks like the pattern is that these changes in the value of the option from mu to 70, from mu equals 70 to mu equals 71 is going up as sigma gets bigger, although there's this like weird non-monotonicity at the end where it drops back down. So one possibility is that that's actually what is happening as sigma gets really large, that somehow this reverses. I'm going to think about intuition in a minute as well. But maybe what's going to go on also is that, that it's just random noise. So I'm going to run this again. And as I run it, I'm going to go back to the intuition that I had before, which is that the main thing that drives the value of the option up at higher mu's is that although there's a slight increase in the probability of being in the money, the main thing is that you just get an extra dollar as the mean shifts up if you were in the money. And the probability of being in the money is getting bigger as sigma is higher. So given that this thing is out of the money, at bigger sigmas, the wider standard deviation gives us a higher probability of realizing in the money. And having run this again, I don't know, I'm now looking at a more extreme range, and it looks like actually we don't actually get this perfect non-monotonicity. But given that I have that intuition about what maybe is going on, it's possible that instead I could just check my logic by seeing what the probability of being in the money is explicitly, rather than looking at the change in deltas, that thing that I think this should just be close to. And I think that I can do that by just summarizing the sims for a given mu. So we're just going to try a given mu, and let's see, we're going to summarize the sims which, okay. So we can summarize the sims like this. And we don't want results to compare. We're going to summarize at k mu sigma. We saw that what that returns was an in the money probability as the first argument or the second argument. The in the money probability was the second argument, okay, or the first argument. And so I think I'm going to just be able to get this other estimate for delta. And assuming that I did that right, I'm not explicitly getting a change in prices. I'm just getting a probability of realizing in the money, but I think that that thing should be pretty close. And if I run this one, let's see, hopefully it'll actually be about half the amount of time. And this one I actually see does go up monotonically. So that's kind of my intuition for what's going on. I might want to head over to like a derivatives book or actually I could like head on over to ChatGPT or an LLM and try to explain the problem and ask like, is there a name for this phenomenon or is this a known thing? It turns out this is an option Greek called Vanna. This is a second order option Greek that we have just been doing some Monte Carlo simulation of. This is a second order option Greek called Vanna, which is the change in delta as volatility changes, or equivalently the change in gamma as the underlying gets more valuable. And it turns out that what we've done is we've done a Monte Carlo simulation that shows that Vanna is positive for out-of-the-money call options. Okay, let's move over to our Tesla linked securities. Question 5. We're going to go get data using code like this. And what's the question? Which is to get this and into a single pandas data frame. Okay, so I definitely am going to want to import Yahoo Finance. I could get this data from the URL on the course website without using Yahoo Finance and just read it as a CSV. But let's try to import Y Finance as YF. Okay, that is done. And now we're back down here. Should have just split the window rather than scroll up and down or searched for import. And here is the code that I used to generate the CSV, but I, of course, don't want this as a CSV. I want it as requested as a data frame. Okay, so that looks like it may get me set. Okay, what assets do TSLA and TSLL refer to? So I'm going to go need to do a little bit of research. TSLA is the car, et cetera, manufacturing company Tesla. TSLL is a levered ETF. It uses derivative instruments and other financial engineering techniques in order to try to generate daily returns, which are either 1.5x or 2x levered, the daily returns generated by Tesla. And that leverage ratio changed in the middle of the sample. We could see that doing our research on what the asset is, but we're also going to see that sneak preview once we look at the data a little bit. Let's describe the data set. So let's just start by seeing what's in there. It looks like we've got more observations for TSLA than we have for TSLL. The means, obviously, these are adjusted closing prices that we got out here, which is the default that we get when we look at closing prices as downloaded from Yahoo Finance. So they're dividend or split adjusted. Let's see, for what days is Tesla data available? So if we take just the Tesla data and drop NAs, and then we take the index for that thing. It looks like we've got data on TSLA starting on June 29th, 2010, ending on April 2nd, 2025, which was the end date that we requested in our data pool. No, we ended on April 3rd, but Yahoo Finance actually ends the day before that. And so we've got 3,714 days. We could check, and indeed those are trading days on the equity market. So we could do the same thing for TSLL. And what we're going to see is that we only have data on TSLL for trading days starting on August 9th, 2022. There are 665 of them. And we could check whether there are any days for which we have data on, let's see. So let's check whether there's any days for which we have Tesla data. So let's check whether the Tesla data is not NAs. So there's where Tesla data is not NAs. Actually, you know what? Let's just see. So we have a total of 3,714 observations. And for every one of those observations, we have TSLA data. So we know that there are no days for which we have TSLL data, for which we do not have TSLA data. And then the other thing that I would just want to check is that there are not any days after August 9th, 2022, for which TSLL is missing. So let's just make sure that if we get, let's get the first element of that index. So that is, oops, okay, so this is where we start to have data on TSLL. And so let's just start our data frame there. And that is 665 observations. And that's how many observations we have for TSLL. So it is not the case that we are missing any days data for TSLL after the sample starts. There are probably more efficient ways to check on that, but we should describe what's going on. Okay, what was the arithmetic average and standard deviation of daily returns for the two asset classes? We're going to limit our analysis to the period for which data on both assets was available. So let's make a returns data frame that we get by only focusing on the 665 days for which we have, no, those are prices. So let's get percent changes. Okay, and so that's going to generate a data set that only has the returns. I'm just going to look overall. The mean is higher on Tesla than it is for TSLL than it is on Tesla. But let me check. Wow, there's a max of 43% daily return, 22% daily return, a min of -50 and -30. Lines up pretty well with leverage ratios of like 1.5 or 2. And nothing too crazy. There must have been some really good or really bad days on those things. Okay, so we could actually see the mean and the standard deviation there. Let's check. So there's the describe. We can see them on the screen. Let's actually get the returns. You know what? We could just pull them off from the describe, but I think we can do it like this. And so we've got means and standard deviations for the two of them. And we could check the ratio. So that's like good stuff for us to see of TSLL divided by the same thing for TSLA. And so we get that the average return for TSLL is 1.72 times higher than for TSLA, and the standard deviation was 1.76 higher. Now, if there was exactly a constant leverage ratio, I would expect that thing to show up here. But of course, there could be like some tracking error, and I bet the levered ETF probably charges some expense ratio to the assets under management, which is something that I could go check. That would explain why the mean ratio is a little bit lower than the standard deviation ratio, because expenses would come out and lower the mean return on TSLL. It could also be that the standard deviation is a little bit higher than the leverage ratio they're aiming for, because they have some tracking error or something like that. So stuff that might be potentially worth discussing. Okay, so let me try to just see if I can see those things. So we got these guys like that. I wonder if I could, oh, I haven't imported pandas, have I? Let me import pandas. That'll be useful. So let's import pandas as PD. Okay, and I'm going to just take these guys that we just generated and looked at, and let's call this thing, let's call that the output, and then let's make a new column called the ratio, and let's make that equal to the thing that we just created. And so if that worked, okay, now we can see those guys separately. So that's a nice one that we could do separately for each one. So we can see those guys there. And now what we could do is we could do something like, we could say for year in, we're going to do this separately for 2023 to 2025, range 2023 to 2026, and we could do what we just did, and oops. Maybe like that. Is that going to work? Okay, so that would give us an analysis by year. A little bit hard to see which one is which. So let's print year. And we will just put a little header above each one. So they're not gorgeous, but, oh, I'm getting the same result for every year. Why? Because, of course, I didn't want to use returns here. What I wanted to do was, and there'd be a way to do this using a group by instead. So we could group by year, but let's just do this guy equal to returns, and we're going to do, we could filter returns with returns.index.year equals year. So returns.index.year equals, and then we want to run this using our filtered one. Let's see, how does that work? Okay, and interesting. Okay, so now what we see is that in 2023, Tesla went up, TSLL went up. The ratio is a little bit less than 1.5. The volatility ratio was very close to 1.5, although slightly above. In 2024, TSLL and TSLA went up. They went up by a little bit less on average than they had in 2023. The return ratio for TSLL is actually a little bit larger than 2, whereas before it had been down like by 1.5. The standard deviation ratio is a little bit less than 2, but pretty close to 2, a little less though. And then in 2025, both are down. TSLL is down slightly more than twice as much. And the standard deviation ratio is also 2. So anyway, a little bit more that we could dig around and explain on there, but there's an idea. Okay, we're going to limit our analysis to the period for which data on both assets are available. Okay, so let's use df.dropNA. And this is going to be the df both like this. And we're being asked to plot the price of TSLA over time. So we want df both TSLA dot plot. Okay, and we can see the price of Tesla going up and down over time. We're going to plot the ratio of the two prices over time. So let's get the ratio TSLA over TSLL. You know, those graphs look like they are inversions of each other. So when TSLA is going down, the ratio between TSLL and TSLA is going up. TSLA and TSLL is going up. And when TSLA is going down, the ratio is going up. So what's going on? Well, this is actually just about, this is about compounding with the leverage. So if you imagine having two assets, and let's say, you know, the TSLL and TSLA are at the same level. Let's say they're both at 100. So they traded a 1-to-1 ratio. Now TSLA goes up. TSLL should go up even more. And so all of a sudden now the price ratio between TSLA and TSLL is going to go down. If the price of TSLA goes down, the price of TSLL is going to go down more. And so the ratio is going to always move in the opposite direction. So this is not about volatility. And you can kind of see that these graphs are just a scaled mirror image of each other. Okay, plot the ratio of the prices, plot the ratio of the two returns, and of the two prices, and then plot the ratio of the two returns over time. I've already actually got a returns data set, so we could use this rather than remake it. And what we want is we want to do this, except we're going to use the returns. And what we get, and you know what, let's flip it around just because I know that TSLL is supposed to have bigger returns than TSLA. And what we see is that actually this thing was steady around 1.5, and then it moved to be steady around 2. There is some spikes and dips above and below. So that's largely going to come from denominator bias. So when the Tesla return was very close to 0, even any moderate expense or tracking error is going to drive the ratio away from the target leverage. It's possible they had larger deviations. We could check. We don't necessarily have to, but we could do something like this. So we could get something like Seaborn in there if we wanted to do some further investigation, and we could check something like we could check. Let's see. So we've got a returns data set. We could add a ratio column equal to the returns on TSLL divided by the returns on TSLA. Okay, let's see how that looks. And then we could say something like, if I wanted to check whether this is about the very small returns, I could check small and make that equal to an indicator for whether TSLA returns. Can I do something with the absolute value of that? Is that going to work? Let's see. Can I take the absolute value of a series? Yes, I can. And so I could say whether that absolute value is less than or equal to, I don't know. That would be, let's say less than, I don't know, what about 10 basis points? What would be a good threshold? Okay, looks like our 25th percentile return on TSLL is, oh, of course, that's not going to be on the absolute value. Well, let's just see how we do. If we make that column, okay, it looks like that's only 15 returns that are less than 10, daily returns less than 10 basis points. Let's try something like that. Okay, and we've now got that the mean, oops, that didn't do it. Let's just see, let's just try it. Okay, so we could now investigate something like, let's put x equals the ratio on the x-axis and the, let's do different columns for whether they're small returns. And so it indeed looks like as long as returns are on Tesla are greater than plus or minus or outside of 50 basis points, we're pretty well clustered around the return ratio of either 1.5 or 2. And we get this much wider dispersion when the returns are really small. So what's going on here? Well, we could go read a little bit more about the, we could go read a little bit more about exactly what is going on. But since I'm not going to go check on the internet, I could say something like start equals and end equals, and let's try. So let's try to just see. This looks like that breaking point is maybe somewhere in 2024. So let's try 2024-01-01. Okay, let's investigate what happens if we go from the start to the, whoops. From the start to the end, and oh, I could actually do better than this, couldn't I? I could just, since I now created a ratio, I could just check returns, what's it called, ratio with a capital R. Okay, so that should be, I should be able to just plot returns. Okay, so that's the plot now, and I should be able to do something like, let's just zoom in on the year 2024. Let's go from the beginning of 24 to, looks like 2024-06. And indeed, it looks like maybe sometime right around, okay, so sometime right around, looks like April, they maybe switched over from 1.5x leverage to 2x leverage. And we could go check that is indeed what happened. Okay, so I mentioned thinking about expenses on the ETF, thinking about denominator bias. So dividing by a small number could blow this up, tracking error from the use of derivatives or otherwise, and the policy change that we've zoomed in a little bit. So things that were potentially worth exploring. Okay, Make a Python list containing tickers using this. I'm not going to go over to the web browser, although I should. I'm just going to try to do this all in code, but I want to actually go look at the data itself. So let's read this HTML page, and okay. And so we'll call that wiki page. And let's see what we got. Okay, looks like we've got two things on wiki page. Let's see what the first one looks like. It's a table of constituents. And I remember, although I should go look at the web page, the second one, element 1, is when things got added. Okay, so let us work with the 0th element. That should give us that table, that data frame, rather, of elements. So we've got a data frame that's got the elements. We're asked to make a list. So, and call it tickers. And that should be a list of what's in the symbol column. So we'll get the symbol column, and we could use the toList method or just use the list function. And let's check and see how we've done with that. And indeed, now we should have a list of tickers. We do. We check that it looks good. How many are in the list? Okay, what's going on? Ooh, we have 503. So we should go check over on the web page, but we've discussed this issue in class. This has to do with the fact that there are some companies that have multiple share classes included in the S&P 500. So we could go look over on the web page and try to identify those. I would also note, so we've got a column called security. So there's the names of all the securities. And I could see, I think, from looking at the web page, like maybe if I look for the word class in there, like maybe I could find some that actually, okay, so the ones that contain the word class, it looks like we've got Google and Goog, we've got Fox A and Fox, and we've got News Corp and EWSA and NWSB. So these are the 3 companies that drive us from 500 tickers up to 503. These are the multi-class stocks where multiple classes are included. Now, I remember there being some ones that had like some weird stuff like dots in them or something like that. We're going to see that when we look at the long tickers in a minute. So let's see the tickers in our list. Was there a dot? Okay, BRKB and BFB. So those are Berkshire Hathaway B and Brown-Forman B. But why? Those were like, why were they not included? And I want the symbol. That gave me all of them. If the symbol contains a dot, weird. Why would, okay, well, let's just look for DF. Oh, I bet maybe it's looking for interpreting a dot as being, maybe any character matches a dot. I'd have to go check. But let's look for BRKB. Okay, and I see. So this is Class B of Berkshire Hathaway, but because Class A is not listed in, because Class A is not in that, the S&P 500, the Wikipedia page does not list it as being multiple share classes. So it looks like these are the three that pushes us from 500 to 503, and maybe BRKB and BFB. I could go do some Googling. I'm guessing these are multiple class shares in the firm, but only one class is included. And actually, now that I think of it, I'm pretty sure that like Meta and a bunch of other companies actually have multiple share classes, but only one of them is in the S&P 500. So these guys show up with a dot in their ticker. But otherwise, okay, what are the longest S&P 500 tickers? Are any of them companies with multiple share classes? So let's check max ticker len equals the max of the len of T for T in tickers. And let's see how long it is. The answer is it's 5 is the maximum length. And let me get a list of T if len T equals max ticker len. So let's get the tickers for T in tickers. Okay, and so we've got 3. Google, which we already noted was Alphabet Class A. BRKB, which we could go check, is Berkshire Class B, and CMCSA, which is, I think, Comcast Class A. Is there a Comcast Class B? Yes, there is, I believe, or maybe it's a Class C. I can't remember. We'd have to go do some research on the internet. Let's just see what we've got for these guys, and that is it is Comcast. I believe it's Class A. We'd go do some research on that on the internet and write it up. Okay, suppose you wanted, without using Wikipedia data, to figure out how many there are. Make a list. Provide a prompt. So I would prompt something like, without using Wikipedia data, please figure out how many single-letter S&P 500 tickers there are, and make a list of them. And when I run that, I and many of you got lists that include significantly fewer than the number that we're going to get. Using the data in tickers, how many single-letter tickers are there? So we have code like this. And let's check. So these are single-letter tickers. And we're going to do, oops. And you know what? There's different ways, but let's do this. And then we can see that there are 10 of them. And there they are. What order is that in? Well, that's got to be the order that they came originally off of the Wikipedia page. And I'm realizing that's probably sorted. It's not sorted alphabetically. It's probably sorted alphabetically by company name. So anyway, maybe it's a little bit, there's 10 of them. We could do a little bit more digging. We could see a little bit more about what DF ticker length equals the len. Whoops. I guess we had, it's called symbol. And we could take, I think we could do that. See if that worked. Yes. And then we could do, let's just see the DF. Let's see those guys where the ticker length is equal to 1. So here they are. And, interesting. Okay. So we've got tickers. There's the 10 of them. I would want to understand if I can identify any logic to which ones the LLM missed. Did they miss like the newer ones, or did they miss the ones that were added to the S&P 500 after the training data set? Well, I'm not sure, because looking at the date added, it actually looks like none of these single letter ticker firms were added to the S&P 500 after your LLM's training data set closed. So it doesn't seem like that. Try to figure out a little bit about what's going on as part of that comparison. Could be interesting or useful. Okay, so If I had to hypothesize about the relationship between ticker length and the size of the stock's decline, what might I expect? So one possibility is, like, I don't know, I'm looking at these guys and I'm thinking maybe, I don't know, AT&T founded 1885. So I'm thinking these are probably like older established companies that have short tickers. On the one hand, maybe they're highly international and therefore highly subject to shocks related to tariffs because they're doing international trade in goods disproportionately. I don't know. On the other hand, maybe these long-established companies are particularly well hedged, or they have heavy domestic demand, or they have more or less diversified. I don't know. You know, there's different reasons to form a hypothesis. We could go out and get data on. Well, we have data on ticker length for S&P 500 companies. We could get stock prices on April 2nd, April 3rd. We could calculate returns, and we could use something like a linear regression as a function of ticker length. Certainly, we might want to start with some more descriptive analysis, just calculating average returns and variability of returns across the cross section. We could think about building long-short portfolios on ticker length across not only the extremes, but the intermediate ticker lengths. We could think about trying to do that either across industries or within industries, across firm size or within firm size, in order to assess exposure to other factors. We could backtest these things across not only, of course, the single April 2nd to April 3rd event, but large equity market changes at a daily frequency more generally. We could think about measuring factor exposure for the different portfolios, looking for historical data on trade shocks or policy shocks more broadly. There's a variety of directions that we could take this kind of testing in. And we could choose a short ticker and a long ticker stock. Actually go download the returns data on April 2nd or 3rd. And I would just note that not a good thing to do is to ask an LLM to do this, because they are very likely, it seems, to have just made up stock prices or stock returns for April 2nd to April 3rd, 2025, rather than having worked with good data. That is some ideas about how you might work through some of this stuff. I hope this has been fun and interesting, and I'm going to say goodbye for now.